Hello everyone and welcome back to the Week in Markets here at True Potential. I'm delighted to be joined by Faye Graham, Senior Analyst here and also income expert. We live in an age of unserious politics. It's a message that CEO Jeff Casson and myself took on the road with your financial advisors last month across the country. And of course, events last night between Donald Trump and Elon Musk, one side X, formerly Twitter, the other side Truth Social, continue to demonstrate the unseriousness of our politicians in addressing the issues of the day. Of course, one of those underlying issues remains tariffs, particularly from Donald Trump. So what we're going to discuss with Faye this week is the impact or not on the jobs data that we're seeing. So Faye, let's begin with, first of all, given we're at the end of the week, the non-farm payrolls that she's just printed and your read on that.
Yeah, so the non-farm payrolls are one of the key employment data that we look at really as an indicator for the US economy. And what we saw was that the jobs report was really quite broadly in line with expectations. So the US economy added 139,000 jobs in May, which was just slightly actually more than expected. I think the expectation was for about 130,000, so slightly better. So continues to show that the US labour market is resilient. If we look at the unemployment rate, that's unchanged at 4.2%. So I think the data is quite consistent with a strong but normalising labour market.
So we're not yet seeing any impact on the jobs data from tariffs. Yeah. So this casts a shadow on the sentiment data we're seeing. So some of the more sentiment-based surveys about future expectations for jobs growth. And there is really a divergence now, isn't there, between those sentiment and the actual measured hard data?
Yeah, exactly right. So I think, as you mentioned, the survey data paints a lot more of a pessimistic picture on the health of the overall US economy compared to what we're actually seeing from that hard jobs data. So if we look at the ISM PMIs, for example, which is sort of a survey-based report used to gauge the health of the US services and manufacturing sector, we had data on that released earlier in the week, and that was actually quite weak. So we had the services PMI slip into contraction, joining the manufacturing PMI, which has been in contraction for a while now. And if we look at the subcomponents within that, we had employment remaining quite weak for manufacturing, but actually pick up a little bit for services. But as we've seen in the hard data, it's not that weakness isn't really coming through. So it's possible that that negative sentiment within the survey data is potentially just a bit overdone, really.
And it's probably what stock markets are actually focusing on is more the hard data because of the shift in narrative of the tariffs, which is Trump has really pulled back. Much of the survey data is probably going to age quite quickly and is too reflective of what happened in March and April. Yeah. Equity's always forward-looking. That's why they're performing so well, is they're probably thinking that the tariffs which are eventually in place will be much more modest than we thought. And perhaps we're already seeing that in some of the growth forecasts because we had a weak Q1, a modest contraction in the US, but some of the early numbers, those nowcasts are actually indicating quite a strong quarter ahead.
Yeah, exactly. So some of the early readings for Q2 have got growth coming in at about 4.5%. which is quite strong compared to that mild contraction that we saw over Q1. So I think, the strong labour market is really supportive there behind those growth numbers. And with growth remaining quite strong, suggests that the Fed aren't really in a rush to cut interest rates. But given inflation's quite close now to 2%, they potentially do have room if they needed to, if we do start to see some weakness in the actual hard jobs data. But as I say, it kind of depends on what inflation does as well, because you have got some upside risks.
And I think that's exactly right. I think once the Fed are sure on the immediate impact of tariffs, they are perhaps ready to lower interest rates again, because they have indicated that even if there is an impact from the tariffs on inflation, it's a one-off shock. They're quite confident we won't see the effects of 2021, which became a big inflation surge, 2022, and then it fed through into wages and future price expectations. So it does seem that Federal Reserve members are ready to vote for an interest rate cut at some point in the autumn, should the data remain quite weak, perhaps in jobs data, and should there be greater clarity on the tariffs. Which leads us neatly just our end section, which is on the ECB. So the European Central Bank yesterday met in their early summer meeting, and we had an interest rate cut.
Yeah, so coming into the week, we actually had inflation data come out for Europe as well. So that came in below target on the headline number, so 1.9%. And really that the disinflationary pressures that we've seen there have enabled the European Central Bank to cut interest rates in that Thursday meeting. So they cut interest rates by 25 basis points, or 0.25%, down to 2%, which is encouraging.
So in the last year or so, the ECB has halved the official deposit rate, taking it from near 4 down to 2. We know that inflation expectations in Germany, as measured by market-based measures, are actually below 2%, which bizarrely is somewhat encouraging for the ECB, because it seems to indicate that obviously the market is quite confident that inflation surge is over. We know that the preferred measures of the ECB are actually converging towards 2, and that's allowed them to bring that interest rate down towards 2, such that the real interest rate, the policy rate when you adjust for inflation, is actually now back to 0. And it's likely, as we said, the Fed would potentially follow with further rate cuts in the autumn once they're clear on the outlook for the tariffs. So that's all today. We just wanted to provide some colour on the unserious nature of politics, but actually that the economies, both in Europe, the US and in the UK, continue to do rather well. So it's different between the UK and the US, of course. But so far, there's not been any measurable impact on tariffs in terms of jobs or even the outlook for growth ahead. And that's one of the reasons why stock markets are performing so well. That underlying nominal growth impulse is there. So that's all for today. Please do like and subscribe on the YouTube channel. And also please join us next week for our morning markets videos, where we will bring a UK focus, given we have UK GDP and we have jobs data. Please enjoy your weekends. Thank you.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value and you may get back less than you invest.